If you own a home in Canada and you are over 65, the CRA has a tax credit worth up to $7,500 specifically for home renovations you may have already made or are planning to make. Most seniors I meet have never heard of it. Not because the credit is brand new, not because it is hidden in some secret vault. I spent 28 years working inside the Canada Revenue Agency as a tax reviewer. Over nearly 3 decades, I have examined thousands of tax returns for retired Canadians. The single biggest financial gap I see most consistently is not fraud. It is seniors spending their retirement money on necessary home modifications and completely ignoring the substantial tax credits legislated specifically to ease that exact financial burden. Today, I will show you the two major credits most Canadian seniors miss, how to claim them, how to dig back into your past taxes to recover what you were rightfully owed in prior years, and the one critical mistake that completely disqualifies your entire claim. Before we look at the specific rules, I need to share a real case that came across my desk at a community resource center in Kelowna because it perfectly captures the blind spot I see every week. Imagine a man named Walter, 71 years old. Over the span of 2 years, Walter spent $22,000 making his home safer after his wife was diagnosed with a severe balance disorder. He installed heavy-duty grab bars in both bathrooms. He built a custom wheelchair ramp to the front door, upgraded the hallway lighting, and installed sturdy double handrails on every single staircase in the house. Walter was meticulous. He kept every single receipt. He filed taxes on time yearly. Yet, he claimed absolutely nothing for these renovations. This happened because his general practice accountant did not specialize in seniors' benefits and simply did not know these credits existed. When I ran the calculations with Walter, the total federal and provincial credits he had left unclaimed over 2 tax years came to just over $4,100. Some was recoverable, while some was lost forever. Let me show you what Walter missed, so you do not repeat his mistake. The first mechanism you need to understand is called the Home Accessibility Tax Credit, or HATC. This credit has been in the Income Tax Act since 2016. It is a federal non-refundable tax credit available to eligible homeowners who make qualifying renovations to their primary residence. For the 2024 tax year and going forward, you can claim up to $10,000 per year in eligible expenses. The federal credit rate is set at 15%, meaning the maximum annual federal credit you can pocket is $1,500. But most provinces add their own matching provincial version right on top. Combined, this single program can be worth close to $2,000 per year in direct tax relief. To qualify, you simply look at the age criteria. If you are 65 or older at any point during the tax year, you qualify automatically. You do not need a doctor's note or disability certification. If you are under 65 but legally eligible for the disability tax credit, you also qualify automatically. Furthermore, if you are a supportive family member housing a qualifying senior, you can claim this entire credit on your own tax return on their behalf. The legislation is specific about what counts as a qualifying renovation. Eligible expenditures are those that allow a qualifying individual to gain access to the dwelling, be mobile within it, or significantly reduce the risk of harm within the home. In plain language, this covers grab bars, structural handrails, walk-in showers replacing high-threshold tubs, external wheelchair ramps, widening doorways to accommodate walkers, installing non-slip flooring, and upgrading interior lighting to eliminate fall risks. It even covers smart home technology designed for seniors with mobility impairments. On the flip side, you must understand what does not qualify. General home improvements done purely for maintenance or aesthetic reasons are strictly excluded. Replacing drafty windows does not count. Renovating a kitchen for modern cabinets does not qualify. Standard painting, general repairs, or routine flooring replacements that have nothing to do with safety will be denied instantly by a CRA reviewer. The ultimate test is simple. Is the primary purpose of this renovation to allow a senior to access their home, move safely, or reduce the risk of physical harm? If it passes that test and you have the itemized receipts, it is entirely claimable. However, this brings us to the first massive mistake that completely disqualifies an entire claim, and I want you to hear this very clearly. The renovation must be executed on your official principal residence. That means the exact home where you live your daily life. It cannot be a vacation property, a secondary rental property, or a home you own but your independent adult child lives in. If you spend $15,000 renovating your summer cottage to make it safe for your retirement, that spending is completely ineligible for the HATC. Only your primary dwelling qualifies. The second credit is newer, less well known, and worth far more money. It is called the Multi-Generational Home Renovation Tax Credit, or MHRTC. This powerful credit came into full effect for renovations completed after January 1st, 2023. It allows eligible homeowners to claim 15% of up to $50,000 in qualifying renovation costs. The purpose is to help families build a secondary, independent unit within their existing home, so that a qualifying individual, defined as someone 65 or older or eligible for the disability tax credit, can move in with them. The structural rules are strict. The space must be a completely self-contained living unit with its own private entrance, dedicated kitchen, private bathroom, and designated sleeping area. It must be physically attached to the primary residence, and crucially, the unit must be newly created. You cannot claim this for simply refreshing an existing basement apartment. The most important aspect of the MHRTC is that it is a fully refundable credit. Even if you have zero federal income tax owing, the government will cut you a check for the 15% credit as a direct refund, making it a goldmine for lower-income seniors. To appreciate the true financial power of these programs, you need to see how they interact, because you can actually stack them together in the exact same tax year. Consider Brian and Sandra. Their daughter is converting their basement into a new, self-contained secondary suite so Sandra's 78-year-old mother can move in. The total construction bill comes to $62,000. Exactly $50,000 of that total spending qualifies for the MHRTC, instantly generating a flat $7,500 federal refundable credit. Now look at the remaining $12,000. This money was spent on specific accessibility modifications inside that suite, such as grab bars, widened doors, and a zero-threshold walk-in shower. These expenses qualify perfectly for the HATC. When you add it up, Brian and Sandra's total federal tax credits from this single renovation project hit a staggering $9,000. Layer the provincial credits on top, and the combined benefit easily exceeds $11,000. Yet, when they broke ground, they had no clue either credit existed. I know many of you are thinking about money you already spent on renovations years ago, assuming it is gone forever. But as a former CRA insider, this is the most valuable secret I can give you. The HATC can be claimed retroactively by filing a formal T1 adjustment request for prior tax years, going back up to 10 calendar years. If you installed a stair lift in 2018, widened a doorway in 2019, or made any safety modification in the past decade and failed to claim it, you can still legally recover that money. I remember a woman who had installed a stair lift in 2020, a walk-in shower in 2021, and grab bars in 2022. She had never heard of the HATC. We gathered her old paperwork and filed formal T1 adjustments for those 3 years. The recovered federal and provincial credits came to just over $3,800. Months later, she received a direct deposit from the CRA for the entire overpayment plus accumulated interest. The process took roughly 4 months, costing her nothing but the time to locate her old receipts. You must realize that getting your documentation wrong can permanently disqualify your claim during an agency review. For the HATC, you must secure official receipts from contractors clearly stating your name, describing the exact physical work, showing dates, and confirming the project was completed at your principal residence. The language matters immensely. Having your contractor write grab bars for shower installed for fall prevention is infinitely better than a vague line that reads bathroom hardware. The specific words are your primary defense if a reviewer challenges your deduction. For the MHRTC, you will need formal signed contracts, detailed floor plans showing the separate entrance, and itemized invoices for every scrap of material used. If your contractor is unfamiliar with these tax credits, sit down with them before the hammer drops to explain exactly what vocabulary you require on your weekly invoices. Trying to hunt down revised paperwork 2 years after a project finishes is a nightmare compared to setting expectations on day one. If any of this applies to your situation, your action plan is simple. First, audit your home-related receipts for the past 10 calendar years, looking for any safety or accessibility modifications, and calculate the total. Second, check line 31,285 of your historical federal T1 returns. If that line is blank for any year where you had qualifying expenses, you have a legitimate retroactive refund opportunity. Third, file a formal T1 adjustment request for each year you missed online through the secure CRA My Account portal. Fourth, if you are planning a renovation to build a secondary suite for a senior parent, speak to your builder about the MHRTC requirements to ensure the blueprints satisfy the self-contained dwelling definition. Finally, if you are a homeowner 65 or older putting grab bars or a walk-in shower into your home right now, claim it on your upcoming return without hesitation. I am a retired civil servant, not a licensed financial advisor. Always consult a qualified tax professional, but I have delivered the absolute legal framework, the agency rules, the exact documentation standards, and the 10-year window to recover every single dollar you were rightfully owed. Walter from Kelowna recovered $3,800, calling it the best 2 hours he had spent in a long time. The government had the money. He just needed someone to show him how to ask for it. And that is exactly what this video was for.